Welcome back to our intermediate financial accounting class. Over the last couple of segments, we've been talking about property, plant, and equipment, PP&E. And specifically, we've been talking about what costs get capitalized into these PP&E accounts. Capitalization, remember, means that we debit an asset account instead of debiting some kind of an expense. We're showing those costs going into these assets that we will then use over time and depreciate over time. Because these are such big numbers, this is an important concept. There's a lot of cost being put into our assets instead of showing up on our income statement. And then those assets get depreciated over time, so they're going to hit our income statement and stay on the balance sheet for quite a while. So these are important things to be comfortable with, these concepts and these methods. As we wrapped up our discussion last time, we ended by talking about the steps to capitalizing interest, perhaps one of the most challenging and therefore most fun parts of capitalization. Now, these are the steps for calculating avoidable interest as opposed to capitalization. But the rule here is that if you are constructing this asset yourself or having it constructed for you, not as a general item that anybody could buy, but for you, then the asset qualifies for interest capitalization. The other qualification is that we're in the capitalization period. So we have started making payments and we have started actually working on the asset. So construction has begun. And we haven't yet got that asset ready to use. Doesn't have to be perfectly done. The capitalization period ends when it's substantially ready to use, meaning loosely that if you absolutely had to, you could start using it now, even though you're still tweaking and finishing up little odds and ends. One of my favorite stories of this was a building built in Salt Lake City a number of years ago, where they were trying to get this huge structure, a conference center, finished in time for a major conference that they wanted to hold in it. And they just couldn't quite get it done. The gentleman who was in charge of the project, as far as the engineering and stuff went to the prophet. It was a religious building, and told Mr. Hinckley that, you know, there's nothing we can do. There's no way this is going to be done. And he basically told him, get it done, or else. And essentially, they got it finished. Not really finished. They actually put some marble siding up and covered some holes in the walls, things that weren't quite ready yet. They put the carpet down, and then later on, once the meeting was over, they actually pulled that facing back off, pulled the carpet back up, finished the underlying details that just hadn't gotten done yet, and then put it all back together another time. So that's what we're talking about with substantially ready to use, is that if you had to, you could use it. Might not be perfect, but we could. So that's our capitalization period. It ends when we could use it if we had to, begins when we've started both paying for it and working on it. So assuming that we have an asset that qualifies and an asset that is in this window, then we can calculate what we call avoidable interest, because the rule is you can capitalize either the total interest accrued for the period or the avoidable interest. Whichever is smaller of those two gets capitalized, and any interest left over has to be expensed. With that as a reminder of what we talked about last time, let's jump into an example. Now, this is Robert's company. Robert's has decided they need a new factory. And so they went out and got a specific construction loan. It's a $1 million 8% loan. In addition to this 8% loan that they just got, they also have two other outstanding debts. In addition to this $1 million construction loan, they also have two other long-term debts outstanding. And those are the only ones we care about when we're calculating avoidable interest, are the long-term debts. So in this case, Roberts has a $200,000 10% note and a $500,000 6% general loan. So that's their outstanding long-term debt, three of them now, the construction loan and these two earlier loans. Over the course of the year, Roberts has made several payments to their construction company to build this factory. And here's our schedule of payments that have been made. And in addition to this schedule of payments, the other thing we need to know is that Roberts paid out $100,000 towards their interest over the year. So they might have a little bit more that has accrued that they haven't paid yet, but the checks going out have been $100,000. What we want to do is a journal entry, yes, to show what interest looks like for the course of the year. What gets capitalized, what gets expensed, what got paid, and what's payable. That's what we're looking for. So we're going to walk through step by step these calculations for avoidable interest, and then we'll compare that to interest expense, total interest expense, and decide what they can capitalize. So our very first step is to get the weighted average expenditures, which, if you remember, It's the weighted principal, what we could have avoided paying interest on if we'd paid the bank instead of paying the construction company. So we're going to create a table to help us calculate this weighted average expenditures. The first line is going to be our capitalization period, or column I should say, and then we'll calculate our weighted average expenditures in the second column. So let's see, if I had paid the bank on January 1st instead of the construction company, I would have avoided paying interest on that $350,000 for 12 out of 12 months. So 350 times 12 out of 12, my weighted average expenditure on that one is the full 350, because I would have avoided interest the whole time. If I make a payment in February, then I would have avoided 11 out of 12 months. And let's see, 450 times 11 twelfths is 412, 500. June to the end of the year, let's see, sometimes I have to count these on my fingers. June, July, August, September, October, November, December. A lot of times we see June and just automatically assume 6 months. But since this is beginning of June, it's a full 7. So 7/12 of 300,000 is 175. Again, we're just multiplying this way. August 1st to the end of the year, 5 months. Again, you can count them if you need to. And finally, this last one was made halfway through the month, so we'd use 0.5 out of 12. And that gives us 10,417. Now, before we add these up to get our total weighted average expenditures, I just want to talk about one last thing. We're making an assumption here with each of these that construction either finished on 12/31 or hadn't ended yet by the end of the year. If construction was finished on, let's say, November 30th, then I would have to change this ratio. I would not change the 12. Interest rates are always out of 12 months, so I wouldn't change this. What I would change is I would change this number. I'd make this 11, and I'd make this 10, and I'd make this 6. If the capitalization period ends before the end of the year, then that limits the time I can capitalize. So I still divide by 12, always divide by 12, but I take out the months from when we finish to the end of the year as well. So let's just do another quick example of this, just to make sure we're comfortable with it. Let's say that I start construction on June 1st and I end on August, and I want to know what the capitalization period is for payments at the beginning of each month. So if I made a payment at the beginning of June, I'd have June, July, August. I'd have 3 out of 12 months. If the payment in July would be July and August, that would be just 2 out of 12, and the payment at the beginning of August would be just 1 out of 12. Again, always divide by 12, because interest accrues all 12 months of the year. We just want to know what fraction of the year I get to capitalize interest, and that's only from the time I make the payment to the time the building is done, or until the year ends, whatever comes first. Let's go back and finish this example. So our total weighted average is the sum of this column, and it comes out to 1,031,250. And that right there is my value for step 1. So step 2 is to break down those weighted average expenditures into financed versus unfinanced. Now, don't forget that when we're calculating avoidable interest, finance has a slightly different definition. We don't mean any money from any investor. What we mean instead is, did you take out a loan specifically for this construction? You didn't go get it from the owners, you didn't pull it from a general fund, but did you take out a specific construction loan? If you did, that's the portion that's financed. Anything above that is unfinanced. So let's put our weighted average expenditures up here. We just calculated from step 1. And if you remember our problem, we took out a $1 million construction loan. So with that $1,031,250, if I had to pay off a loan, I'd pay off the construction loan first, so I didn't get hit with penalties and fees for breaking that special construction loan contract. So I would have to pay off the $1 million first. Anything left over, I will say, is unfinanced. And that's step 2. Now, if my loan had been for $2 million, I'd have put all $1,031,250 into financed. If my loan had been for $500,000 or for 0 even, then I would have put a lot more into unfinanced. I would have paid off the $500,000, or I would have had a 0 there, no construction loan, 0, and everything else would have gone into unfinanced. That's step 2. Step 3 now is to calculate the weighted average interest rate if we need it. We won't always do this. We only need it if you've got something over here in this unfinanced section. And in this case, we do, because we have this $31,250. If we had 0 over here, we could skip step 3. So step 3 is to get the weighted average interest rate. And we do that by taking our total interest expense and dividing by our total principal. And we're going to use all long-term debt other than the construction loan. So in this case, we have 2 debts. We have a note and we have a loan. The principal on the debt is $200,000. The principal on the loan is $500,000 for a total principal of $700,000. In our next column here, let's put our interest rates. So for the $200,000 note, it's 10%. For the $500,000 loan, it's 6%. And now I can multiply. If I take the principal times the interest rate, I get my interest expense. So 200,000 times 10% is 20,000. 500,000 times 6%, 30,000 for a grand total, if I add these up, 50,000 in interest expense. And with these two numbers, I can now calculate my weighted average interest rate. $7.14%. Now, you can round out wherever you want to. I usually recommend going at least 4 decimal places. So 0.0714, kind of a minimum. You might want to go 1 or more, even more decimal places, but you need to at least do 4 decimal places to make sure you've got a good value here. All right, now that we have a weighted average interest rate, I can move on to step 4. And step 4 is going to be multiplying each of these pieces of our weighted average expenditures by their interest rate. So the interest rate on the $1 million, the finance portion, is the 8% of the construction loan. So 1 million times 8% is 80,000. My unfinanced portion, my interest rate is this number from step 3. So if I round this to the nearest dollar, I get 2,231 as my interest on that piece. Again, this is the interest that I would have avoided. Basically what I'm saying is I would have avoided all of the interest on my construction loan, and I could have avoided another 2,200-ish on my other debt, because I would have paid off more than $1 million in principal. So if I add those two together, which is step 5, I get my total avoidable interest. So $82,231. And that's my final value from my avoidable interest calculation. Now that I've got avoidable interest, I can finally move on to the big question. How much can I capitalize of all of my interest expense? And that's the piece that we haven't done yet. It's not in the steps. The steps are just for avoidable interest. But here's the next piece of this problem. We're going to compare our avoidable interest, which was $82,231, to our total interest. And this would be all of our interest on all of our long-term debt. So let's see, we have $20,000 from our note and $30,000 from our general loan. And we know that because we just calculated that as part of step 3 for our avoidable interest. And then we have $80,000 from our construction loan. So we had 3 loans outstanding during the year. All of the interest on those loans comes out to $130,000. So I'm going to compare this number with the $82,231, and the smallest gets capitalized. So I'm going to capitalize my avoidable interest, and most of the time that's what I end up capitalizing. So now, finally, I can make a journal entry. And to make my journal entry, the other thing I need to know, and this was given in the problem, is that we actually send out checks for $100,000 for interest expense. So of the 130, 100 of it's been paid, the rest is just accrued, but I haven't sent a check yet. So let's start with what we know. We know we get to capitalize into our building $82,231. We also know that we send out a check, so it's a credit, for $100,000. The other thing we know is that if there was $130,000 total and I paid 100,000 of it, then I've got 30,000 that's payable. So we'll put it into a cleverly labeled interest payable account. And now the balance has to be what I expense. So interest expense is going to be the plug figure, whatever it takes to make it balance. The other way to look at it is I had 130,000 in total interest. 82,231 can be capitalized, so the rest has to be expensed. 47,769. That also happens to be exactly the number I need to make this journal entry balance. This is my entry to record. Interest, accrued interest. So there's our journal entry. All of the calculations that we did, all of the information that we gathered, all came down to this one entry. Now keep in mind, this is not how we would really do this. This is one summary entry that keeps track of everything that our company has done in making our interest payments all year long. The reality is that we would have made a series of journal entries, probably debiting interest expense, crediting cash each time I made a payment. At the end of the year, I could have made an entry to debit interest expense and credit interest payable for that last 30,000. Then what I probably would have done was take a look at my capitalization and said, you know, I put all of that into interest expense, but I didn't have to. Let's go ahead and take the 82,000 and change out of interest expense with a credit to interest expense and put it into my building. That's more common as far as the way I would actually make these entries. All right, that's a lot of stuff with capitalization. We need to stop there. When we come back, we'll continue our discussion of what kinds of expenses, what kinds of things go into our long-term assets, and then start talking about what happens when we decide to get rid of these assets. More fun to come. I'll see you then.